Let's stick with the earnings theme, though, and go to McDonald's. It reported sales that topped estimates as consumers continue eating out despite those higher prices. Joining us now is Michael Halen, the restaurant analyst from Bloomberg Intelligence. Michael, thank you, as always, for joining us. It looks like higher costs actually worked for McDonald's here, and I'd argue Coca-Cola as well. That's not a dynamic you saw in, say, Walmart earnings. What is McDonald's doing right?
Well, McDonald's is doing a few things right. I mean, number one, really the sales were driven by price increases. They hadn't seen an increase in foot traffic at all. What they're doing better than others is they have scale, right? So they can offer a value menu and they can offer price points that their smaller competitors just can't match.
The other thing, Michael, we were just talking about Shopify, a business that was exploding during the pandemic. In the case of businesses like McDonald's, they really retooled as well during the pandemic, thinking about how many menu offerings they've had. It appears that's allowed them, in terms of having a tighter, more focused list of offerings, to keep serving, to keep focus, to avoid some of those labor headaches we've heard so much about. What would you say about what they have been doing over the last couple of years to get them to this moment?
Yeah, well, a big thing was eliminating all-day breakfast, right? Because that was causing some operational headwinds during the day, and it was hurting their operations. So that was actually, even though it had really spurred their turnaround, 6 years or so ago, franchisees were happy to let it go because it was just causing problems in their kitchen. It was causing more labor. It was decreasing the speed of service in the drive-thru. So that was probably the biggest thing. Most of the companies that we cover had pared their menus during the pandemic.
Well, let's bring it back full circle here and talk about that currency exposure. I think about 66% of its revenue comes from abroad. How much pain is that actually providing to some of these companies?
Yeah, McDonald's obviously is global. It's the largest restaurant company that we cover, and they have a very large international business. So they don't own any company-owned stores, so they actually generate more revenue in the United States. But it is significant. Management said today it was going to be a 14 to 16 cent headwind in the third quarter, and they were expecting 40 to 50 cents next year. I'm sorry, for the full year. So it's definitely an impact. I think a bigger concern for McDonald's is consumer sentiment globally. So consumer sentiment is hitting record lows, not just here in the U.S., but in the overseas and in Europe especially. It's even worse. Inflation's going to be worse in the second half there. There's only so much the lower and middle income consumers can take when it comes to price increases. So, what we've seen is high single-digit increases throughout the quick service industry this year, and it's really a question mark about what that's going to do to traffic in the second half of this year.
So a story of winners and losers ultimately, Michael. Do those consumers have to pick if they're staying with the McDonald's or one of the other players out there?
Yeah, for sure. I expect transactions to fall, because consumer sentiment is so weak right now, because inflation is so high, and because of the wealth effect and what that's going to do to consumers in the second half. So there are going to be winners and losers. There's definitely some companies that we look at, like a McDonald's having the scale, a Yum Brands having the scale that gives them a competitive advantage on the value side if we do return to an environment where discounting returns, and then there's other chains that we cover on the casual dining side, like Texas Roadhouse and Darden, that have been very conservative with their price increases, and same-store sales are exceeding their peers. So we think they have a lot more pricing power than some of the other companies that we cover.